Hi, everyone. Welcome to our monthly presentation with Five Star Chemicals. This month, we have Brewery Financing 101 with On Tap Credit Union. Really excited about this. I think we have some new attendees, so welcome. A couple of housekeeping things before I do the introductions. If you want to say hello, where you're from, please use the chat to the right. If you'd like to ask a question, please use the ask a question prompt at the bottom of the screen because then others can vote on your question up to the top and we can make sure we keep them organized and we can answer them all at the end. I believe there will be some interactive aspects in this presentation, so please just use the chat if you want to answer any of those. And without further ado, I'd like to introduce Mike and Miranda from OnTap Credit Union, and they will take it away from there.
My name is Michael Shepard. I'm the Director of Business Development with OnTap Credit Union, and joining me today is Miranda, whose camera is just off. What's your title? Official title?
Marketing coordinator.
The marketing coordinator, as we like to say. So we're really excited about this opportunity. A great day. I appreciate everybody showing up on the call and not downtown at the ABS celebratory parade, which I'm sure quite a few people are downtown Denver. But a quick introduction for myself, or quick background on my banking experiences. I have worked in the financial world for 15 years. I started with a large retail bank. I was a banker for about 6 months, and then a business banker for just over 3 years, then a branch manager. I've been in the credit union world for about 10 years, and I've worked for OnTap for about 4. And I will tell you, the credit union world is a much better world. We definitely build relationships, and we listen to what our member needs are as compared to a retail bank. Shout out for if you're not a member of a credit union, you need to be a member of a credit union. OnTap hired me to focus on the craft brewery world and find ways to craft solutions to help breweries achieve their financial goals, whether they're a startup or they've been in business for however many years they've been in business. A little bit of brewery side for me is I actually used to manage in the restaurant business, and I worked for Rock Bottom Restaurants, managed the Walnut Brewery for many years in Boulder. Great beer out of Boulder if you ever got a chance to go to the Walnut Brewery. A whole lot of fun. I'm very passionate about the business side. However, I will make you understand too that OnTap can help you or your team with your personal financial goals also. We also collaborate with a merchant service provider, a financial investment advisor. We have third-party payroll services and an insurance broker. So for OnTap, no matter what you're doing in your business world, if you reach out to me or OnTap, we can find a crafting solution for all your financial needs. Just know that that's one of the benefits of dealing with OnTap is if we can't do it, we have a partner who can. A little bit of background, as I gotta remember to tap as I go. Who is OnTap Credit Union? They're beer people helping beer people. OnTap Credit Union started as Coors Credit Union in 1954 by a few employees of Coors. Because employees had to pay for the uniform, the credit union's first loans were to Coors employees actually to purchase their uniforms. This is how we became beer people helping beer people. The credit union continued to grow over the last 68 years. Now we have over 20,000 members, over $300 million in assets, and we have always been member-owned, and our membership extends all over Colorado and the United States. About 6 years ago, we decided to make a name change, but we wanted to keep our beer heritage, which is we felt the OnTap name kept our beer roots and how we became OnTap Credit Union. Here we are almost 70 years later, beer people helping beer people. Fortunately, over the last 4 years where I've been associated with OnTap Credit Union, we have expanded our brewery partnerships to over 40 brewery partners. OnTap has helped them using consumer loans, or business loans to help them open or grow their brewery in a better financial, or put their brewery in a better financial position. And we put some of the logos up there, as you can see. We have Lady Justice, Holidaily, Mad Jacks, Welcome Home, Long Table, Tommy Knockers, Flight Co., Landlock Ales, Mountain Toad, Rails End, Bandit Oak, Six Capital, Guanella Pass, Little Machine, Over Yonder, Joyride, Live Slow, Mythmaker, which I'll give a quick shout out for Mythmaker. They're actually having their grand opening on Friday, July 8th up in Fort Collins. So if you get an opportunity in the Colorado area, definitely go up and see them. Highside Brewery, we just helped them finance with their new brew house. So we continue to to build these relationships, and we're having a great time doing it. I have the fortunate job of being able to visit these brewery owners and do a little financial help for them, and to be able to enjoy their craft beer at the same time. Cool. So this is the first part. We'd like everybody, if they could put in the chat, if it's possible. The question is this, is what percentage of small businesses fail in the first year? So if you have an idea, we just ask you to kind of put it along in the chat. And granted, 2020 was a little bit of an anomaly. However, even if you base the average between 20 and 21, it's still a similar percentage on there. Oh, we're seeing some really large percentages. Wow, there's some optimistic people out there, I think. We're seeing some 80s and 90s. It's a little lower. I'm gonna show you actually a slide. We're just gonna awesome. I love all the responses. We're talking about actually the number of craft brewery closings, and we'll go back to what is the average of small businesses, because they stay pretty consistent. As you can see in this slide, since 2015, there's been a steady increase in the percentage of breweries closing until 2021, when the percentage dropped. Some of that had to do with because there were so many breweries that closed in 2020. It's going to almost average itself out. As you can see in 2018, there's some better guesses. I like the lower numbers, a little more optimistic. In 2018, it's about 22% of the breweries closed in the first year. In 19, it was 25%. In 2020, that jumped to 35%. And in 2021, it was 18. But if you kind of average 2020 and 2021 out, it really was around 27%, which, you kind of have to take into account for the pandemic year. But actually, according to U.S. Bureau of Labor and Statistics, about 20% of businesses fail in the first year. And so the craft brewery industry is actually kind of keeping along those lines. And so we're going to talk about what are the top 5 reasons small businesses fail. And so no market need for your product, but let's be honest, that doesn't apply to the craft world, because everybody loves a good craft beer. The second most popular, the second largest percentage, is ran out of cash. Next is not the right team, get out competed, and then pricing and cost issues. Are you really in line with the market, or are you really in line that you can keep your business running through there? I love that. Somebody's spot on. Celebrating the failure of them. So we don't, we want to help these small businesses not fail is what we want to do. And I will ask you to look at number 2 should stick out the most, because the lack of cash will keep you from paying your employees, your vendors, purchasing equipment, expanding your brand, and or keeping you afloat during economic times or seasonal up and downs. And that's what we find in the craft brewery industry is, depending on your location, you may have those seasonal highs and seasonal lows. If you're fortunate enough to have a steady income and it throughout the year it's the same numbers, that's a benefit, but you'll see those up and downs. And then, of course, who would have guessed we would have ran into the pandemic, and the pandemic definitely created a lot of hurdles for everybody. So as you can see, even through craftbreweryfinance.com, and I find this is really the number one reason craft breweries fail is they run out of money. Cash is the fuel that keeps the business running. You run out of cash and you're done. And that's why it's so important to make sure that somehow you have reserve set up or the availability to get to some short-term funding if you need it. And we'll kind of cover as we go through. We talked about running out of cash while operating a business. Now let's talk about the costs before you even open your doors for a brewery. So another question for the chat is, how much do you think it costs to open a brewery? Please put your guess in the chat. And I'll tell you, there's a lot of different factors. Through some research and through my own experience in helping breweries, this number is pretty consistent. You might be able to do a little less than what the average is, but the costs are definitely going up. All right, we have a couple good guesses. Oh yeah, actually some really good guesses in there. I will have to say, someone put in there 150% more than you think. That's probably actually, always keep that in your back pocket. So I think everybody's doing pretty good on the guesses in there. And we talk about is there's 4 major costs that are associated with this where you'll come up with these numbers. And the first the four major expenses are going to be your equipment. So your FF&E, which means furnitures, fixtures, and equipment, constructions, your permits or your licensing, and then location. Are you able to lease that particular location, or are you going to purchase that location? If you get a great property owner, you might get the opportunity where they're not charging you for the first few months as you get set up. So those are definitely a lot of costs associated with it too. So looking in there, I think you guys are doing a really good job with those numbers. So the cost to open a brewery starts around $500,000, but could reach up to $1 million. Some of the factors that play into this is what size brew house will you have in there? How large is the actual space that you're using? In the Denver market, it's becoming more and more expensive as you go, for sure. And then just looking at some overall costs, or how we come up with it is, as you can see on the screen, that a brew house, we just helped Highside with their new brew house, and it was just over $300,000. But then you've got to figure kegs, canning machine, fermentation tanks, bright tanks, bins, utensil racks, office equipment, tables and chairs, TVs, point of sale systems. So all these things start adding up. So the reason I put these numbers up there, and when you really start thinking about this, is you'll be amazed at how much it costs. And I had someone put in there about 150% of what you think. And, that's a great way to look at it, is when you start looking at these costs, there's going to be soft costs that you don't even realize. These are a lot of hard costs. So you want to take that into consideration when you start opening a brewery, or at least start having the idea of how much money you're going to need. So whether you're just starting out or running an established craft brewery, there are times when you need what we call beer money. I'm sorry to read some of these. Some cheap chairs in there, but you will need beer money. Numerous factors go into finding the right loan. In addition, your business and personal credit worthiness will play a role. For our beer money bootcamp, we will walk you through the factors lenders use to evaluate whether we'll loan you money, and then walk you through the different types of loans, which is really important. So once you start getting ready to go, these are some questions you want to have or think about before you start talking with a business banker. So do you understand your brewery financial needs? Are they short, mid, or long-term lending needs? Do you have the cash flow or income to pay the loan? And does the brewery receive a profit cost savings from the loan? Do you know your credit score? So we take all these, as my screen doesn't advance, take all these questions, and now we're going to be all the factors that we use to evaluate the decision to loan. And I would say in my conversations on a daily basis, we have this exact conversation 2 or 3 times a day, talking with different brewery owners or even business owners about what it takes to borrow and what we're going to look at. So these become the factors that are going to help you out. So talking about the different factors lenders use to evaluate decision to loan, as you can see, there are multiple factors lenders use in determining or deciding a loan. So we are looking at your personal credit, your personal debt and income. If you're an established brewery, or if you're using another business to be able to use the income to pay as a way of repaying the loan, we look at business debt, we look at business revenue, and then finally we take a risk rating score. So we take all these pieces to it, but let's kind of break them down a little bit for you. So all business loans require a personal guarantor from all owners with 20% or greater ownership. What's important about this is they must be on the loan application. Even if they are, quote, silent owners, most financial institutions follow within this range about being 20% or greater. And I really caution everybody to think about it when you're giving up equity. If you're trying to raise money, is think about how much ownership you give up or equity you give to investors, because if they're 20% or greater, we're going to want them to be on that loan application. And a lot of investors they don't want to be in the personal guarantor on the loans. And sometimes you're fortunate enough, you might find somebody that does. So we do. So we look at all the guarantors, personal credit, personal debit, and personal income. I will tell you, especially with startups, a financial institution wants to see what income sources you have to repay the loan. So this is really important. From everybody that remembers back in 2008, when we had the financial crisis with a lot of mortgage loans going under, it was because people were put into loans that they couldn't afford, or in the future, the way the rate was adjusting, is they weren't going to be able to afford these loans. So what is now enacted or law or protection for the borrower, even the financial institution, is this. For some reason, the loan were default, you as a borrower could go to court and show that we as a financial institution had no way of proving that you could afford this loan and you might be absolved of that debt. So two things. One, nobody wants to put a borrower in that position. We definitely want to put you in the best financial position. So we want to make good decisions to help you and help it grow. So you as a lender must show a borrower has the ability on paper to repay a loan. For example, if you're going to stop working your current job to run the brewery, then what other income will you have outside the brewery to repay the loan? So these are some factors to think about. I run into this in a lot of conversations. If someone's going to open a brewery and they decide they're going to stop working, well, we want to see other ways, or we're going to need other grantors potentially to be on the loan. Now, let's say you have historical income. So let's say it's an existing brewery wanting to borrow money. We start looking 2 to 3 years of income and profit. We cannot use the brewery's forecasted income, but let me kind of clarify a couple items. For startups, OnTap Credit Union will review a business plan, right? Everybody has a business plan, and we review quite a few of them when people are presenting it. A business plan is a great way for trying to get investors, but for a financial institution, we will look at it. But really what we're seeing is we're looking for a breakdown of timelines and for sales. We want to see your process projecting sales or revenue versus expenses. And even though we can't use that forecasted income, if we're going to lend money, we want to see that there's some thought process to it. And we've seen quite a few of them. The better detailed you are, and if you can use and talk to other breweries to get a compensating numbers for maybe the size you're going to be, definitely try to reach out to other breweries to kind of get an idea of their sales. Now, however, let's talk about existing breweries. So OnTap Credit Union will use forecasted income. For example, let's say a brewery wants to purchase a larger brew system. They want to purchase more fermentation tanks, or even we run into this where they might want to purchase for increasing their barrel output. They might want to purchase a canning line for distribution. We still base this loan decision on your current financial situation. However, where we say we want to put you in a good spot is we just want to make sure that you're able to truly pay for itself. So if you're going to increase that volume, do you have the funds to pay for it now? And in the future, will you even be able to grow more? And so we do take all those things into consideration. Second piece is for breweries who have been operating for 2+ years. And I will say also, I run into potential brewery owners who have existing businesses, and we'll use the same information when it comes to existing businesses. We look at a brewery's debt versus income, and we use a ratio called a DSCR, so that debt service coverage ratio. Our minimum is 1.2. So what this means is that for every dollar in debt, you have at least $1.20 in income. So it's showing that you're making a profit. That's what we're looking at when it comes to this ratio. So the higher the DSR, the better. So if you get to 1.75 or even 2, it means that for every dollar in debt, you're making $2 in income, which is great. We definitely want to see that. So again, when using the revenue, here's what's important. We only use the historical and current income. As we talked before, not forecasted income. I will say on tap, though, when we're trying to craft a solution, we have been looking at, and this is for existing businesses, that 2020 is a little bit of a different anomaly, and we've had some people not really show very good sales, or at least show income. We've actually used, compared to year over year, 2019 to 2021. So we try to get a better understanding of your income, and there's anomalies. So we also run into, if there's a reason for it, we've had somebody who's paid off a whole lot of debt. We've had people who've had to buy back so much beer because they had an issue with the beer. So that cost them a lot of money. So if you ever run into these anomalies, it's important about documenting everything that happened in there. And there needs to be an explanation. So that'll help the underwriters kind of fully understand what's happening. Second piece, or the third piece of it, We look at your business cash flow and your global cash flow. I think this is kind of surprising to some new borrowers when we talk about the global cash flow. So global cash flow means we're reviewing everything. We're looking at your personal and any business income and debt together to assess your risk and your ability to repay. So this is what's important. We cover this whether you're a startup or whether you're an existing brewery, because eventually, whether you want to borrow money or not, it's important that you're showing that you're making income to be able to borrow money. So we look at the personal and business taxes to get a full assessment on that global business and cash flow. Cool. Nice. Just checking out the chat to make sure we're all doing well there too. So here's the other thing, and this can be new to a lot of people. It's risk rating. So finally, the underwriter takes all these factors that we're talking about and generates what we call a risk score. So the lower the score, the better. The risk rating number helps to determine if the loan should, one, be approved, then what's the rate and what's the term. So the higher the risk rating, the number impacts the loan approval. So you look at it this way. It's like golf. You want a lower score. OnTap Credit Union uses a scale of 10. However, we lend within what we call a risk of 1 to 4. So what's important about that risk rating is compared to what somebody might look for a term rate sheet. So you as a consumer, you want to go out and borrow money and buy a car or even a house. Everything is determined and your income plays a factor, but your credit score is the biggest driver for what's going to happen with your rate on a loan. So if you go to buy a house or a car and you're an A+ credit, you're for 60 months, your rate will be this. When it comes to business lending, because everything is based, risk-based pricing or rate is based on the risk-based pricing, we take all those, it comes into a number, and in that number, we have a sheet that'll determine the type of loans, which we'll talk about next. But when you go into that factors and you're looking at the different types of loan, if you're risk rating 1, then your interest rate has a potential for being lower. If you move up to risk rating 4, then your rate will move up, and then depending on the term. So they put all those factors together. So I don't know if anybody's heard about risk rating, but that's really how we look at a business loan and the difference between a business and a consumer loan. Just making sure, keep an eye on that. So now we talked about the factors that we look at for decisioning the loan. This becomes the largest amount of my conversation I have with all brewery owners, potential brewery owners, is the different types of loans. And the biggest thing that happens is, there it goes. The biggest thing happens is talking about the different pros and cons, but it's really about your needs versus your wants. People come in and they say, I want this loan. And, it's really important that your banker kind of digs into really what your needs are. And we'll kind of talk about that a little bit further. But there's so many different options for you when we get into the lending needs. And as you can see, these are the most popular types of small business loans that we deal with. As you see on the screen, there are several kinds of business loans. What we do, as I was talking before, is OnTap Credit Union is craft that solution that fits your specific needs. So consider these loans like picking hops for your beer. There are many choices, and sometimes like brewing a beer, there might be a specific hop or even a combination of hops that fit your needs. So sometimes the solution is completely different than your original idea, and that goes back to what you may think you want, but actually what you need may be something a little different. And sometimes it's a blend of the two different type of loans to kind of achieve what you're looking for. And I know in looking at all these different types of loans, the credit cards, lines of credit, terms loan, equipment loans, SBA loans, commercial real estate loans, they seem kind of overwhelming. However, again, a good lender listens, then crafts the lending solution to accomplish these goals. You'll find that some financial institutions, people are just really order takers. So someone comes in and says, hey, I want a business credit card. They just say yes, fill out the information and try to get you approved for it. But we kind of want to find out what you're doing with it. What are those needs? So we'll break these down loans and fit. We really want to fit your needs. Are they short-term, midterm, or long-term lending needs, and the pros and cons for each? And there's several for it. So that's again why we want to dig into, find out what you want to accomplish, and to see your full financial picture. That's the other thing that's important. The reason why we dig into a little more into your finances is, or what your story is, we really want to find out what you're trying to do, and we might have a better idea. We might even be able to save you a little bit of money while you do it. So a common question, or a common option, is a business credit card. And a business credit card is what we call short-term need. Business credit cards are generally used to make your everyday purchases. If you're buying ingredients, if you're buying supplies, or just general merchandise, vendors can keep the number on record for convenience of ordering, and you keep it in your pocket for ease of use. And so the pros of using a business credit card are, you charge your purchases during the month, and the payment's not due for 2 to 3 weeks from the statement. What that means is, for example, let's just say you have a business credit card, you're making your purchases all for the month of July. Then for on tap, the payment's always the 25th. Your payment wouldn't be due until August. Great way to help with your monthly cash flow, and a great short-term need. So you, in essence, have bought about 7 weeks before you have to pay that loan back, so you can generate revenue, or you can figure out how to make profit, and kind of balance your month off. So if you pay that statement balance off, there's no interest that's accrued. So that's really important. You want to make sure that you understand that that's one of the biggest benefits of a credit card is you pay it off the statement balance every month, then you're not paying interest. The other is, with On Tap, we have rewards. So for every dollar you spend, you get a point. The other neat benefit, as you can see in that image, is we actually partner with the Colorado Brewers Guild. So we have their logo. We also partner with Pink Boots. We have their logo on their credit card. So you're helping support the Colorado Brewers Guild at the same time. Here are the cons. It's going to be a higher interest rate. We go back to that risk-based pricing. Everybody has to understand, when it comes to businesses, interest rates are always going to be higher. So the interest rate is always going to be higher on a credit card. Cannot be used for cash purchases without a cash advance. Now, on tap, where normally if somebody does a cash advance, they're going to charge you a higher interest rate, and the interest starts right then and there. We don't do it that way. There is a fee to do the advance, but you don't pay a higher interest rate. Rates are variable and can adjust. That's actually both a pro and a con. Based on what the Fed has been doing and the way they keep moving the rates, all credit card rates are going to increase again. I think they're up over 125 basis points over the last just 6 months. But we go back to the pro about using a credit card. It's a short-term need. So if you're paying it off in the statement period, you're not paying a whole lot of interest. However, if you take 3 months to pay it off, remember, it's an annual interest rate. You really do not pay that much in interest, and a great way, an easy way, convenient way to help you with your cash flow. Another great tool for you to have is a line of credit. And I have more conversations about line of credits than I think about anything else, because people always ask the question, again, that want versus need. They want a line of credit because they want to buy equipment. We'll kind of talk about that, but a great tool. And again, I think the short-term lending needs, make sure everybody has at least something of a short-term lending option for you to be able to make purchases that'll help you with the cash flow. But so the line of credit, the great thing is it provides quick access to cash. So a line of credit, you just draw that line of credit into your checking account. You can swipe your debit card. You can write a check. You can do ACH payments, and great way to help that short-term cash flow, make quick purchases, pay off discounted invoices. Actually, a line of credit is a great way to go as you deal with some of your vendors. They might do a net 30 we talk about. And, when someone pays an invoice, they say if you pay it within the first 30 days, they're going to give you a 2% discount. You can actually save money by using a line of credit to pay that off, which we can talk about that in the future. It goes a little deeper in the type of loans, but typically unsecured. And again, man, everybody should have one. Here's the pros. So those seasonal large purchases or emergency funds, everybody has seen it. If you own a current business or brewery, there's waves of when you have your high times and your low times, or if you need to buy supplies or something breaks, right? A line of credit's a great way to take care of that. Only pay the interest on the amount drawn. So if you have a $50,000 line of credit, the advantage is you draw $10,000 out on the line of credit. You're only paying interest on the amount that you draw, so only on that $10,000. Just like a credit card, you're able to pay down the line of credit, use the available limit during the draw period. And here's something important to know about draw periods. With OnTap, it's a 5-year draw period. We'll review your financials again in 5 years, and then we renew it, and it has the opportunity to either increase that line of credit or potentially could decrease the line of credit. But again, it's a great tool to keep using, and we can constantly keep it moving as we can look at your financials every 5 years. Another benefit of a line of credit over the credit card is rates can be lower than a credit card. Lines of credits can be a little harder to get approved for because they're going to typically be unsecured like a credit card, but your rate's going to be much lower. So that's another benefit compared to the credit card. Monthly payments are low. Typically, a line of credit is only about interest only, or maybe even not even 1% of what the balance is or the draw is out on there too. So we're going to kind of relate that to a con on the other side. So lines of credit, the cons are just like the credit card. It's a variable rate. So it's moving with prime. And again, the Fed is moving it. But, I would encourage you that it's because these are short-term needs, that interest rate shouldn't affect you because, again, you're going to be paying these off within a short period of time, less than a year typically, and more like 3 months is a better way to look at it. Con is a no grace period on interest, whereas, a credit card, you swipe it, you're not going to have a payment until the payment statement due date. With a line of credit, interest starts accumulating the minute you use it. So that's something to think about. A line of credit, you don't want to draw it until you have to. So if you advance to draw, that's that piece that you pay the daily interest. Con is the low payments, and this is what I was going to talk about where it becomes a con, is it's typically interest only. So if you're using that line of credit, which I say constantly have this conversation, if someone wants a line of credit to buy a piece of equipment, that may not be the best way to go, and it shouldn't be the best way to go because unless you are adding additional principal, you're not going to reduce that amount or the balance on the line of credit. And hopefully that kind of makes sense compared to a term loan. If you carry a balance for a long period of time, the line of credit actually could be closed and set up a term loan. Set up as a term loan because we want you to be able to pay off that debt. But I'm going to give an example real quick of how I say where a line of credit can work out for you in the short term, and it rolls into something else that's going to benefit you in the midterm, actually what it is. So we had a brewery that was looking to buy equipment. The equipment was going to show up or the payment was going to be due until 3 months, and the equipment was 6 months out. So they just had to put a deposit down, and in 3 months, they had to make the full payment. So here's what a line of credit can do for you. Exactly what we did for that brewery is you have the availability of the line of credit. They were able to make that first down payment. Then what we did is in 3 months, when they were ready to make the final payment because the equipment was on its way on the boat from China, is we actually finance a term loan for them and use it to pay off the line of credit. So you kind of see where you can kind of use a blend of these different loans to help each other out. But again, I'm going to say it over and over. Line of credit, short-term lending needs. You should have something set up where it's a credit card or a line of credit. You should always have that available for you. The benefits are huge. But again, it's for a short-term lending need. Don't turn it into the point where you're going to use it for a long-term need. So term loans. So term loans are what we call a midterm lending need. So that's greater than a year, but less than typically about 7 years is what we're talking about for when it comes to lending on there. So that's, again, this is why we want to have a conversation with you. The conversation with the brewery owner I gave the example before was we took the benefit of a line of credit until we needed to actually borrow, because the term loan is going to, once you borrow, the interest is going to start accumulating from that point on. So there's several different types of loans with a category we call term loan. Typically, a term loan is used to purchase equipment or a business vehicle. As you can see, we have our on-tap van out there helping you deliver all your beer to your distributors. You can also use a term loan to consolidate multiple loans to reduce your payments into one fixed payment. So especially for startup breweries, and the reason we talk about what your financials look like with 2 to 3 years and be able to lend is you need to set yourself up for success in the future. So if you're starting off as a brewery, you may use, and as an example we helped with a different brewery, was they used every single credit card they had to be able to start their brewery, to start making money, which was great. After a few years, they were established, they were showing income. We actually took all that credit card debt, turned it into a term loan for them, and that greatly reduced the amount of interest they were paying. They would finally have a goal to pay it off, because, if you've ever seen your credit card bill and you look at it and it has that little box in the top left corner, I think it is, and it says, if you make your minimum payment, it's going to take you 25, 30 years to pay it off, which is a very long time. And that's okay if you're first starting off, but that's just kind of an example of how term loans can go and why it's so beneficial that from the get-go, you have a plan to kind of help yourself out, use what resources you have to get those doors open, but start showing a profit and making money. So let's kind of talk about the pros and the cons that we have for term loans. So if secured with collateral, it's a lower interest rate, fixed payment rate, and time for paying back the loan. So there's how you can help yourself budget, right? So good for budgeting purposes is this is going to be your payment, and you're going to pay it off in 3, 5, or 7 years, or even 2 or 1 years. We can actually help you out with that situation. If it's not secured by collateral, it's a little bit higher rate, but it's a great way to budget and consolidate that debt that you've been paying. The cons are if rates go down, which, and currently with the Fed, I don't know if we're going to have to worry too much about that. The Fed keeps raising those rates, but it's fixed. So if you ever want to look at reducing the interest rate, we can always look at refinancing. Prepayment penalties for paying it off early. We on tap do not have prepayment penalties. If you're able to pay it off early, we celebrate that for you. You pay a lot of the interest in the beginning, so paying it off early can actually benefit you. If you get a term loan with any financial institution, make sure you review the terms and if there's any type of prepayment penalty. As I was talking about before, you pay most of the interest in the first few years. So that's why some financial institutions add that prepayment penalty, is they want to make sure if you pay it off early, they're still able to make the interest income. On tap does not. We're here to help you out. We want to put you in a better position. And if you pay it off early and it makes sense, then we're going to fully support that, because there's many other lending needs we can help you with. And then the con is, can you afford the monthly payment? And if you remember, when we were talking about the different reasons when we want to look at if it's forecasting just because you want to buy a new piece of equipment that's going to add money, add income to your brewery, then will this asset really add income or have a cost savings for you to justify the purpose? That's where we're going to look at those numbers. Does it really make sense that you're going to buy this piece of equipment, that you really thought the process out and you just don't go buy it because everybody else has it? And we've ran into that when distribution was really taken off. Everybody was ready to jump into that, but the cost associated with it, and now with aluminum, is so high. If you can afford it, Ball is not letting people order cans. So, we do talk you through those things. And again, On Tap is really there to help you through this process and partner with you, collaborate with you through the whole conversation and through the whole lending process, because we want to see you succeed. We want to keep offering the opportunity to grow, give you that beer money to keep you moving along. The next one is, enjoy my Joyride glass. The next one is probably one of the largest categories that people talk about, and it's an SBA loan, so the Small Business Administration Loan. This is your long-term lending need. These are going to be 10 plus years. Not everybody is an SBA approved lender. Not all lenders provide SBA lending. Just like the previous loans, an SBA loan can be secured or unsecured. And kind of an understanding how it works. I'll tell you, when you go out there and SBA is like, just contact your financial institution, they'll take care of it. They think everybody's going to be approved, but an SBA lending process is a longer process, more tedious, and not everybody is approved for it. And I'll kind of show you a breakdown of a loan, but the way it works is the financial institution is taking on about 50% of the responsibility of the loan. SBA is about 40%. You're the one that has to come back in with about 10% of your equity input, and then all the closing costs associated with it. So that's why an SBA loan can be a popular loan, because there's just less cash for you to put into it. So, good for larger project purchases, less money needed to obtain the loan, reduces the risk for the financial institution. But again, you have to be an SBA approved lender. We on tap are not SBA approved lender, but we partner with two different groups that provide the SBA lending. So we vetted them. So we trust that when we refer, that they're very good with it. The cons of an SBA loan are higher interest rates and closing costs. Rates are significantly higher. And actually what happens with an SBA loan is this. An SBA loan, when I broke it down, it's 50% of the financial institution and 40% of the SBA. They're actually two separate rates. It's two loans into one. So there's what's called a blended rate. You only make one payment, but it pays off the loans. But there's closing costs collected on the financial institution and on the SBA, and the SBA is typically much higher with it. Startup breweries are considered high risk, I should say. They may not have the opportunity, and I put on apply, but in fairness, anybody can apply. It's a little harder since COVID because breweries fall in the category of restaurants. However, it doesn't mean that you cannot get approved. It just means it might be a little bit hard of a hurdle. That prepayment penalty, we have helped a couple breweries pay off SBAs recently, and SBA, one was 7 years into a 10-year loan, and there still was a prepayment penalty. SBA has a lot of restrictions with it. What you pledge is attached to the loan, and I'll give you an example here shortly, but remember, they really want to see your house. So whatever you pledge when it comes to an SBA loan, you cannot sell or refi that property until the loan's paid off in full. So typically with an SBA loan, when you go to do, if it's going to be a construction, and we'll talk about the two types of SBA loans, is you're pledging every asset that you have in there. You're pledging the brew house, all the tanks, the kegs. So you can't sell those things. If you attach your house to it, you can't sell that. So a lot is involved with that. It's a longer process. One brewery we're currently dealing with it, we're going to try to help them in. They're 3 months into an SBA loan, and they're still not seeing the light at the end of the tunnel. So typically what happens in an SBA loan is you can kind of get close, and they require more documentations. And please understand, this doesn't discourage you from the SBA loans. They help out a lot of different breweries. You just have to be ready for a long process and provide financial documents, constantly provide financial documents. Typically when financing out, there's little to no collateral available. So, again, we're trying to base this on if you're a startup or what it's going to look like in a couple of years. There's a lot of people want to get rid of their SBA loans. And if the SBA loan involves any type of construction or build out costs associated with it, when you go to refinance it, it's hard because what the hurdles are, there's no collateral attached with it. And I'll give you kind of an example. So we helped out a brewery who was trying to refinance out of the SBA loan. The payments were extremely high. However, the collateral for the SBA loan was less than $100,000 now. It had been too many years, but the balance was $200,000. We were actually able to use their home to kind of help pay that out. Positive side is we've helped different brewery owners refinance their SBA loans that they've been paying on for many years, and the collateral is still there. It was basically down the equipment. So we can do it. They were making money. The big horror story that I've heard with this, and again, it's just really stressing so you understand what you're pledging and why. Brewery owner bought a building, built a brewery, pledged the building and pledged the house and all the equipment and their primary residence. Well, they're ready to retire. They've been operating for several years. They're ready to retire. They can't leave. They can't sell their home until they find someone to buy the brewery and buy the building, which isn't impossible, but just kind of understand those pieces to it. For an SBA loan, there's two different types of loans that are associated with an SBA, and this is really important. The SBA 504 is specifically used to purchase commercial real estate. So if you want to buy a building, it's a good way to go because you don't have to put as much cash into it. It's a good way to start out with. An SBA loan that most likely most people deal with is what we call an SBA 7A loan. It's a general purpose loan. So this can be used in conjunction with purchasing a building, commercial property, construction, purchasing the FF&E, purchasing an existing business. In fact, they even have 7A lines of credits. And again, that's all backed by the SBA, or 40% of it's backed by the SBA. So there's a lot of different ways you can use that 7A. So SBA 504, just used to buy a building, and then SBA 7A, which can be used in conjunction with a building purchase. And the way that works, too, is that it starts off as a line of credit. You're not able to draw on it. They'll pay as it goes. And then once that draw period's over, it turns to the term loan, just like we talked about if you do a conventional line of credit. I did a quick breakdown of what a small business administration loan looks like. And again, long-term loan need. So let's say it's $1 million that you need to borrow. And I've seen this with several different breweries over the last 4 years. Is the initial loan was about $1 million. They had to put in their equity injection, which was 10%. So it's not as much down. SBA backed 40%, and the bank financed the other 50% of the loan. So again, it's still just one loan, but it's 2 in 1. And that's how you come with the breakdown. The cost we're going to tell you that the closing costs with is, I'd really estimate more like 15% is what you need because of the closing costs associated with it. But this kind of gives you a general idea of how it works. And this works the same way for that 504 or a 7A. Again, someone used the $1 million. They built out the brewery. They had all the equipment. They did everything. They had to put their money into it. And then we were able to refinance a couple of these. But you kind of see why that if the equipment value isn't there later, it's going to be a little harder to refinance it. But with some strategy going into it, it's actually a good loan. Get your doors open and make some money, but it definitely can help you out. And we've been able to help some people get out of their SBA loans, and we save them anywhere from $2,000 to $4,000 a month if we can get them out of the SBA loan, just on the interest rates alone. Cool. So the last one I want to talk about is commercial real estate, or CRE loans. You'll see them listed. Again, this is a long-term need. Used to purchase commercial property. A conventional CRE loan will usually require 20% down. So this is where the difference is in that SBA loan compared to the conventional commercial real estate loan is you're going to need more money down. And then again, you're going to have closing costs versus the 10% required on an SBA 504 loan. I'll tell you, a big proponent of this. If there's a way to do it, I think purchasing a building is a really good way to go. Business can set up talking to your accountant, business can set up a separate entity to purchase the building and lease back to the brewery. No rising leases. I'm sure you've talked to brewery owners, and we've even some that were just priced out of their building and had to move. The building owner sold the building. If you own the building, you're not worried about the rising leases. No fear of the owner selling out the building out from underneath you. And it's a great asset to use as collateral. It's awesome. And like any real estate, especially in the Denver market, that's something that's going to increase in value. So you're going to continue to have a gain on it. The cons are that large amount of cash required. 20% down is quite a bit. If you're struggling to just open the brewery, then being able to buy a building can be pretty difficult. The other piece of it is you're responsible for all maintenance, insurance, and taxes. So when something breaks, you're going to have to fix it. So we go back to that line of credit. Short-term lending needs are, if something breaks, can we have a line of credit? And we can even back a line of credit using the commercial real estate as an asset, is being able to try to fix all of those. So these are the typical loans that I have a conversation with. And again, we go back, it's just why we want to have these conversations, why there's so many different options. The best play is you start with your local business banker, and then we can determine your need to craft your solution or your lending needs. So we kind of look at it this way. So there's 4 ingredients that go into brewing beer, and we kind of look at there's 4 ingredients into brewing up a loan that's best for you to get you your beer money. So the first type of loan, the first ingredient is, what type of loan do you need? Right. So that's the beginning of the conversation. And then what dollar amount do you need? A large conversation, again, in talking to it, is they'll ask for a dollar amount, assuming that's all they can qualify for. But let's look at your whole picture. Let's look at really what you need. Third ingredient is, what is the guarantor's income, debt, and credit score? The fourth ingredient is that risk rating, where we take all that information and we come up with a number to be able to come up with it. And then with these four main ingredients, we brew up a loan that helps your business grow without jeopardizing the brewery financially, which is key. I say it all the time. We do not want to put you in a bad financial position. We don't want to be an order taker. We definitely want to look at your entire picture. Another benefit is of talking to a banker, will tell you, is we can look at your whole financial position, and then we can develop a plan for you that's going to allow you to grow or give you the advice on what you need to do or different avenues for going. The last thing I'd like to talk about is some alternate loan options. And this is big. The first one's big, and I'm always amazed at people don't realize this option's out there. It's called owner carry finance. So the owner of the building or equipment acts as a financial institution. And we say make sure you have an attorney that can review the terms of the loan documents. However, if you find a brewery that's inexistent or even a building that you want to buy and you cannot get financing through a financial institution, it's talking to the owner to be the owner carry or owner finance. They act as a financial institution. It's a good way to be able to purchase that building or the equipment. The downside is make sure you understand the terms and conditions. And these are typically very short-term loans. These people don't want to own the building anymore. They don't want to own the brewery anymore. So they're really looking to get out. So they'll give you a short term to where you can start your business, start your brewery, start making income, and then be able to use a financial institution. And again, that's why I go back and talk about what we look at if you're an existing brewery is you game plan this and you do an owner carry, owner finance, and you can get your brewery open, which it can be a great way to do it. It's just making sure that you're showing a profit. So eventually we can help you get away from that higher interest rate and give you a longer term. It's going to be a much more manageable payment. Second one is hard money lenders. I'm sure a lot of you have heard about hard money lenders. You can get the funds you need to purchase the equipment or the breweries just to get your doors open. And sometimes hard money lenders provide you a short-term lending option on there too. Interest rates are going to be really high. And that's the downside of it. They're short-term and high interest rates. Again, just know what you're getting into with those hard money lenders. Again, if it's the only way you can get your brewery doors open, I tell everybody, just evaluate what's important to you. Do you really think you can make this work? And then have a strategy to be able to pay that loan off, because eventually it's going to come due, and hard money lenders don't typically wait a long term. Last one is friends and family. And I'm sure everybody's gone through this process and made their pitch with their business plan and talked to their friends and family about investing. Here's what you want to think about. Pros is you can delay the repayment until you start making a profit. So that's important when you start doing that equity piece to it, or people start investing. You have to spell out how you're going to repay them. The con is this is kind of a hard way to raise money, but as a financial institution, we know that you have investors and they have to be paid back. We want to see what the terms and conditions are for repaying those investors. So important to talk with existing brewery owners or an attorney is how are we going to set this up so that it makes sense? And a lot of times you see it until the business starts making a profit, you're not going to have to pay them back. If you have to pay them back sooner than later, this really generates a debt that we're going to have to consider when we start lending you money. Another one I didn't put in there, but I mentioned in the beginning, I would tell you, we do this a lot. And I use that example where we helped a brewery pay off their $200,000 that was left on their SBA loan, and we use their home, we use the cash out of their home. It's attached to their home no matter what they do. We can find crafting a solution for you that might involve using your home or your car. And it just did it with a startup brewery. They're hoping to open their doors in about 4 months. They needed to buy brewery equipment. We were able to look at another resource, and that's using their home to be able to use that money to buy that brewing equipment. And again, I stress this all the time. You need to find a way to open your doors to start brewing and start making money. If we have a good plan and we have a strategy that you can start making money and be able to actually move the lending all into the business, you're going to be able to open that door. You're going to be able to open that brewery and then start selling beer to everybody. So called it a boot camp because it's kind of fast. It's kind of hard. A whole lot of information coming at you one time. And I know it sometimes can be overwhelming. I have these conversations all the time, but I'm here for any questions, any comments, anything I can help you with. Just let me know. It looks like we have some asked questions.
All right. Do you want me to read these to you, or do you want to read them off yourself?
Can you pop it up if you just click the button? Yeah. Okay.
You seem to be pretty comfortable looking at the screen too.
Yeah. So can we tell in the orders is the first question then? Okay. So the question is there a formula that would help to determine the startup working capital needed when purchasing a brewery? Would it be better just ask for a larger line of credit? What factors are involved with this type of decision? Great question. So this is what I always suggest when people say, how much should I ask for or how much should I borrow? I have to put it back on the potential brewery owner. When you're determining all the different costs that are associated with it or working capital, you're going to have to figure out, let's just use labor, right? There's going to be labor, there's going to be electricity, right? Any and all soft costs that might start up with it that you need to know, I need this much money to pay all my bills in month one. Then I say, take that number, multiply it times 2, because as you generate all those bills, you're going to, before you pay it off in the next month, you're going to generate those bills again. And sometimes I do a multiplier of 3. That's just a decision for doing that short-term lending needs. So if you start talking about the startup working capital, that's what I look at. In the grand scheme of things, you really want to have a 6-month reserve of working capital. Here's where that line of credit can benefit you, right? If you're able to get a line of credit based on that multiplier I say to use, we could potentially look at setting up a line of credit that will cover you for 6 months. Cash is better. Cash is always king. But that's how I determine how much you need. And it's really laying out in your business plan. You should have already laid out what you think your electrical costs are going to be, labor costs are going to be, supplies that you're going to buy, all the malt that you're going to buy, anything you're going to purchase, the aluminum that you're going to have, and because labor is really a big one. Marketing is going to be another big one. Advertising will be a big one. So use that multiplier. Hopefully that kind of helps answer your question. And I really use that formula for everybody. Is take your first month and then we're going to multiply it by 2, if not 3. The big way would be 6 months, but it's a little harder to get that 6 month with a line of credit compared to cash. Next question was, I've seen lenders not include freight in their loans for receiving equipment. Freight is a massive cost imparted on new barriers right now with supply chain strategies to have these strategies to have these costs incorporated with loans. So we just did 2 different loans that involve, actually 3 different loans that involve brewery equipment, 2 full brew houses. We incorporated all the costs associated with it. We did. It's better to present it. So if we think you can financially afford it, most of the time, even though those freight or supply chain costs have gone up, they're not compared to the equipment itself, because as those costs go up, the value of the equipment is actually higher. So you're paying more money for it. There's usually in new equipment, we've been able to incorporate that full price into it because we need you to start up. What we ran into and why we try to help brewery owners in crafting a solution is, listen, because we lend you the money to buy the equipment, if you can't, 1, pay to install it, 2, pay to have it shipped to you, what good is that equipment? It doesn't do us any good. So we look at it, and we have had no issue on the last 3 loans that we've done incorporating the freight associated with it too. So my best advice is make sure that you add that into the cost. And that's the difference in when we talk about on-tap credit union is beer people helping beer people is we fully understand that. Your typical retail banks and credit unions who don't want to be in this realm of the craft brewery industry don't get that concept. And that's usually why you might get pushback when you're looking at it. And the last piece that I'll tell you is that we always you're going to receive an invoice from the supplier, and we want to see that full invoice. And they usually break down everything on there so we can actually see based on the percentages for it. So we partner with a couple different groups. Centennial Lending is one of them that we partner with. The benefit with Centennial Lending is we really are your point of contact. We decision the loan. We do everything for it. Centennial is a CUSO that's associated with 25 different credit unions. They only deal with credit unions when it comes. Well, let me rephrase that. They deal with credit unions who refer business. They actually are independent lenders also. And you probably see Centennial located out in Firestone. However, going through on tap and then allowing us to go through Centennial get you the benefit and get you a better rate and get you less fees associated with the loan. And that's how we're able to partner with them. And they've been, Centennial's been around for a long time. In the last 10 years in the credit union world, I have been dealing with Centennial for those 10 years. And I believe they've 15 to 20 years they've been in existence. There's a third-party lender that I use for smaller deals. It's just a third-party SBA. He's really a broker, and he was able to help us because we're not an SBA lender. I was able to refer over so that they could use their resources to do the PPP loans, and I'm sure you all heard about them, those payroll protection plan loans. And that's it. I built a relationship with them. I've had two other resources that I've used, but the two that I use primarily are the ones where if I refer them, it's no different than me doing it. I want to make sure that they're going to handle you just the same way that I would handle you as my member. And those are the two that I deal with. And I would say, reach out to me and we can have a conversation and I can get you in contact with both groups if needed, just kind of depending on what the lending needs are. Centennial really deals with the larger loans, where the other provider that I have deals in the smaller loans. And that's why I like the two relationships. They both fit a different need.
And as the follow-up of this presentation, I will send Mike's contact information for everyone.
Perfect. Let's see. Generally speaking, how much cash do you think a brewery will need before going to banks? So it's really going to depend on what type of loan that you're looking for. And it's why we covered all those different loans. What do you think you want? What is really what you need? And so we need to get a good look at the whole picture, but let's break down a couple of different ones. If you're going to, with a credit card and a line of credit, that short-term lending needs, we're not looking for bringing cash to the table. Term loans will be different. So we talk about term loans can be like buying a vehicle, buying equipment, consolidating debt. Depending on if that collateral is new or used, we may only finance up to 80% if it's brand new and 70% if it's used on like brewing equipment. A vehicle would typically finance 100% of a vehicle. We might require some down. Again, it's going to really take all those factors that we said into brewing up a loan for you. Is what percentage of down payment do we need? Let's go, if you're going to be looking at starting a brewery and all those soft costs associated with it, that's where it can be a little more detailed and a lot harder conversations. But I would say, just like when we talk about a commercial real estate loan, that's at 20% plus closing costs. So I say 25%. So if you're looking at buying equipment, I would always look at buying equipment, especially if it's new. Again, looking at that 20% is what you're going to have to put into it. And then when it comes to used equipment, we finance up to 70%. So you're looking at 30%. And those are just some general rules that we have, or our guidelines that we have. Other financial institutions might be a little different, but we call it skin in the game. And that's really it. Is there an opportunity to do 100% financing with equipment? There can be, but we've only done 100% financing on equipment on existing businesses, on two different ones. And one, we only did up to 90%, but these were breweries that had been in existence for a long time. If you're a startup, that required cash is going to be a little bit higher. So the next question is when purchasing an existing brewery, what is the likelihood that an owner, there he goes. When purchasing an existing brewery, what is the likelihood that an owner equity would be 10% versus some higher number? What factors drive this? So I think make sure I understand that question. When purchasing an existing brewery, so if you use an SBA loan to purchase the brewery, then you're definitely going to want to do 10%. And that's just an SBA guideline. It's a minimum of 10%. It could actually go up. What factors drive this number to where there may be more required? is if they want you to bring a larger equity influx, is it's really going to be based on what we talked about that risk rating. What is your personal credit? What type of revenue is actually going to be generated from it? They may be able to use those numbers if it's an existing kind of turnkey operation, but really ultimately is what's your ability to repay and what's the risk associated with it. And that's where we get that risk rating. The higher the number, if it's higher, then we're going to require more. And that's where I'm talking about when we're financing that brewery equipment, where we were able to go to 100%. The risk rating was a great risk rating, was a 1. The risk rating where we required a little more down was the risk rating was at 4, which is at the highest number that we'll use for borrowing. So those are the factors that go in with it. And hopefully that makes sense. That was Ken. If it doesn't, pop another comment in there if I didn't answer it, or another question, and I'll answer it. Are there options tailored for veterans? So there are options tailored for veterans. However, in the lending world, you can't, I don't know what word I want to use and use it right. You can't specifically say this person can get a loan based on they're a veteran. There are programs out there that will allow a veteran-owned business is a check mark that they have particular lending that goes that direction. We don't have lending that's tailored specifically to veterans or any other groups, but there are some programs out there. I'll tell you where you find a lot of great programs that are specific to different groups. Are always visit your city's business development. Whatever group that is, whatever city it is, make sure that you talk with them, their business development group, and find out what programs they have. Some of those cities even have their own grant programs, and then some of them are tailored to different groups to bring in more diversification into locations. They'll give you grants that'll help you get started in your business, and that's really the best area when you're looking at options that are tailored for specific groups. What are the pros and cons to leasing equipment with low buyouts? So, did I miss this one though? Or that one just pop up?
Yeah, you're good.
Okay. I feel like the questions pop in and out. So what are the pros and cons to leasing equipment with low buyouts? So the pros and cons are really going to be based on what is your ability to repay, and then what is the benefit of owning it. And we're actually going through this through a lending class. Is there are benefits if you own that piece of equipment, you can depreciate that equipment, what helps reduce your taxable income. So that reduces your debt income, which is a great benefit. And this is where an accountant is a great resource for this. And I say this, if you're starting a brewery, you need to have an attorney, an accountant, and a business banker. Those three are going to be in your corner to help you out. They don't always agree on the best way to go. I'm going to tell you to show income. Accountant's going to say don't show income. But back to the question for the leasing against owning, that's going to be the benefit for you. Can you really afford that payment if you buy that piece of equipment, right? You might have to give that 20% down. You might have to put 30% down to buy that piece of equipment. Can you afford that cash right now? Whereas leasing, a lot of people go through the leasing and even renting kegs, is that you can lease a piece of equipment and then there's a small buyout at the end. Again, if that leasing payment is a better option for you, and ultimately that piece of equipment you buy is going to generate more money or save you on expenses, then it's worth every penny. But really that accountant's going to help you drive the best option between purchase and leasing. But I will tell you, the same as say alternate sources of borrowing is owner carry finance. Leasing's another one of them. If you can lease a piece of equipment and it's going to help you make money. The second benefit is this: leasing or purchasing that piece of equipment. Leasing a piece of equipment, the maintenance is typically not yours. If it breaks, they fix it. Leasing a piece of equipment can be, hey, I'm going to lease a piece of equipment, let's say a canning line. I'm going to lease it. I'm going to start distribution, and distribution takes off like crazy. Then you can see actually the value of potentially of buying that piece of equipment. So a lot of factors come into it, but just make sure the accountant's going to help you on paper the best way to go. When initially opening a new brewery, there's a lag between equipment setup, licensing, and actually making product. Are loans expected to be paid at day one of? Actually, so loans are going to be expected to be paid on the due date. So the example I gave you where we used the line of credit to make the down payment so they could order the equipment until they had to make the full payment on the equipment to return a term loan. That's how we try to help you with the payment. It's less of a payment and put you in less financial burden. However, when it comes to making your payments for equipment, is as soon as the loan is booked, depending on the financial institution, payments are due within 30 days of the loan being booked, and that's when your first payment's going to be. Here's what I would say. There's always the option when talking with a financial institution of, can you get 45, 60 or 90-day deferment on the first payment? So that's always an option. And again, we're going to go back to the risk rating and everything associated with it. If it makes sense, then we can have that option. So it's always negotiating in the beginning when you're setting up a loan and asking those questions. Is there availability to where I can have a delay payment of 45 days or 90 days? And that's even, I'll tell you, even if you get set up and you open your brewery and you're having issues with making payments, make sure you talk to your financial institution immediately. We're here to help you out. We want to set you up for success. And so there can be a deferment. You saw that during COVID where payments were deferred. What that means is, some people call it skip, but you don't skip it. That loan payment's added on to the end of the loan. So that's some different options for you. But make sure you just talk about it, try to negotiate it in the beginning. Good question. What drives some institutions to have a higher or lower debt service coverage ratio? Also, I'm going to lose my voice. At what point in projections does DSR need to be 1.2 from the start after 6 months at a year? Okay. So it's risk. So institutions going to determine their DSCR depending on risk. So generally you see that 1.20, and that's what I've seen through financial institutions. If somebody's a little more conservative lender, they're going to want to see a higher return on the DSCR. At what point is projections from the moment, that first month when you start making it, you want to be able to make that payment. There can be some initial startup costs that might put that DSCR to be a lower number, but that's where in those projections, as you start predicting it, we want to see. And so we'd love to see it that it's from the immediate you're going to start making money. But on an annual basis, when we review it, we look at every 12 months. So if you borrow money from us, we want to see year over year, is that DSCR staying a constant 1.20? If it goes down and you have a line of credit with us, that's where it can affect your line of credit. If it goes up, that's great. It may give you an opportunity to borrow more money. But that's why financial institutions review your financials on an annual basis. We want to see that you're keeping consistent at that 1.20. The reason I say from the start is this: you want to do your best to make sure that that piece of equipment you buy or whatever loan that you're getting is going to pay for itself. Granted, the supply cost could be a little bit, or the introductory cost could be a little harder, startup costs on it. But we're going to take those numbers, and over a 12-year period, we're going to look at it. Just make sure it just makes sense. Let's see. This is the next one, right? Mm-hmm. I had an SBA loan from a local bank in 2017, $125,000 for my brewery equipment. My lease fell through. I made one payment and paid off the loan. The next month, no prepayment penalty. Closing costs were not bad either. Man, that's awesome. I will tell you, if you have an SBA loan and they didn't do a prepayment penalty and a really good closing costs, that's awesome. I just stress, in my experience in dealing with it, they have the closing costs can be pretty high, and the prepayment penalty for the last 3 loans that we helped pay off, and one was 7 years into a 10-year term. So again, that's that piece of doing your research. Make sure you understand what collateral you're pledging and what it costs you to borrow that money. What are all those costs associated with? And if you pay it off, are you going to get a prepayment penalty? Well, hopefully, that's Paul. Hopefully you were able to find another location. Next question is working on getting financing and am a little short on the 20%. A local economic development center is processing a gap loan. Awesome to achieve 20%. would Untapped Credit Union accept the gap loan as part as my skin in the payment? So we definitely will, something we'll look at. So what we want to look at is that gap loan. What are the terms and conditions for it? When is the repayment due? Some of these gap loans that you'll see is they're deferred for X number of years, sometimes X number of months, or they have you only make an interest only payment, and then the principal and interest payment starts after X number of months. That's what we want to look at. That skin in the game, that can be a great tool. And as long as it makes sense and it doesn't affect overall what income you're making compared to the debt, then it's definitely something we can look at. It is, so for the DSCR, is the 1.2 income gross or net? Net. Everybody's going to drive off the net. The gross number can be a really big number, and that's the fancy number. And a lot of times in conversations, people tell me what that top number is. I need to get to the bottom. So we want to see, after everything's said and done, your income compared to your debt is a 1.20 on net. Good question. Next one. We bought land in the same year, just sold another property and looking to subdivide on the new property and build and lease to ourselves. Oh, I got you. That's Paul who sold. Great job. You know, that's that piece to do is if you are the owner of the land and the property, you can definitely set yourself up for success. Good job. Paul, what state are you in? Hopefully he answers that question. You know, this is, you know, what I do really love about these podcasts is, you know, it generates a lot of questions, a lot of interest, and it's so important that you have a conversation with the banker and you feel comfortable with this conversation. There's a lot of different avenues to go through. There's a lot of different questions you may not realize. Oh, Paul's up in New York. Thank you, Paul. Is a lot of questions come out of this, and it's really that conversation that we need to have. That's why it needs to be in depth. It's not an order taker. Please put yourself in a better financial position and have a good, solid conversation with someone like On Tap. We're here to listen and kind of guide you through that process.
All right. Thank you so much. I appreciate all the questions. As I said before, I will send Mike's contact information with the follow-up email. Once again, another reminder, this is being recorded, so I'll send out the recorded version so everyone can refer back. And our next presentation is July 28th. So if there are any other questions, thanks again, Miranda. Thanks again, Mike.
The last thing you say is thank you. I was going to say, never be afraid to ask questions. Email me. I'll even this I put out there. If you're going another route and you want me to look at what they're offering you to see if it makes sense or not, I can review it. My VP can review it, and we'll let you know if it makes sense or if it doesn't make sense. We're here as a resource. We'd love to be your lender. If we can't, we're definitely going to help you.
And also, we will have Mike back, not next month, the month after that. So this is a series of presentations. So be sure to check back with our schedule.
Wait, what? Just kidding.
If not, he's locked in now. All right. Thanks, everyone.
Yeah.
Have a great day.
Yeah. Thank you.